Hello, guys. How are you? Fine. Today we are going to look at companies. So the main party of what we are going to discuss or look at uh, pertains to the companies. So to start with, would you first look at the a recapture of what we look with other forms of business organizations like sole traders and partnerships. So, as we discussed on the previous videos, we looked at sole traders. That's a one-man owned or one-man run business, and its main disadvantage is the aspect that there is lack of continuity. That if the owner dies, then the business will not be able to continue to operate in the foreseeable future. The other disadvantage of a sole trader or a sole proprietor is that there is unlimited liability. So if the business fails, the owner's personal possessions, such as cars or vehicles or houses, might be attached by the creditors. So for that reason, you will also find that the sole traders, they have a disadvantage when they are running their business. Okay, so now we also looked at the disadvantages of a partnership. Right, so partnerships, they suffer as well from unlimited liability. Partnerships suffer from unlimited liability. That is, if the partnership fails to pay its debts or it owes some funds to creditors, then the personal possessions of the partners might actually also be attached. And the other disadvantages of partnerships is that um, there can be circumstances or situations where there are disagreements between the partners. And if there are disagreements within the partners, then the partnership may be dissolved. So partnership suffer or fail to operate in the foreseeable future due to some of those reasons. Now, let's look at the main part or focus of what we want to discuss today. Remember, we want to discuss about the companies. Okay, so to start with, we would first define what is a company. So a company is formed when two or more shareholders come together and they raise capital through what is called issuance of shares. And those individuals who raise capital through issuance of shares are referred to as shareholders. There are instances where we can have single shareholder companies in other states. So you can have a company which is owned by one individual. Other countries allow such a situation. But in general, most companies or businesses, entities act or companies act in most countries, they now only allow um, two or more individuals to form a company. In other words, a company cannot have less than one shareholder. This is done to ensure that the interests of other parties are protected. Now, we have what we call types of companies. So, the main types of companies which we are going to discuss here will be private limited company as well as public limited company. The main focus on companies or advantage over other forms of business entities is that they have limited liability. What is limited liability? To start with, let's first define the term liability once again. Liabilities exist when a business borrows or when a business is lent some funds. So the lender, be it a bank, be it a financial institution, or any other creditors, might supply, be it machinery and equipment, raw materials, or money to the business. Hence, those things become liabilities. So in accounting terms, liabilities are funds which a business owes to other parties. The parties which are owed the funds by a business are referred to as creditors. So liabilities are amounts which a business will need to pay. Now, let's go back to the part of the term limited liability. What it now means when we are now having limited liability is that when a business borrows funds, the business, if it fails to pay back those funds or to repay the funds to be it a financial institution, which in this case we have referred to as a creditor, the business the business assets and possessions are the ones which will be affected. All right, so the business possessions are the ones which will be only affected. The owners of a business, in this case, this business which we are referring to as a company, are called shareholders. They are called shareholders. We'll talk about the different types of shareholders later on. But the first part of what we want to look at is shareholders provide capital. There might be ordinary shareholders or preference shareholders. But at the end, all of them, they are party owners of the business. So for big entities or companies such as Coca-Cola, IBM, Philips, Colgate, Unilever, BP and Shell, Total, Econet Media, Vodacom, Safaricom, MTN. Those entities, they have shareholders. And then when they are having shareholders, what we mean or say there is that those shareholders are party owners of the business. They are part owners of the business. All right? So they become party owners of the business. So someone will purchase shares within the company. By purchasing shares, they are given a share certificate. Then they give money to the company. The money is referred to as the capital. So shareholders contribute capital for the formation or for running the business. So that is what shareholders do. So there is contribution of capital by the shareholders. All right. So what we are saying is shareholders are the owners. Now, the difference between companies and other entities like sole traders and partnerships is that the shareholders are there to contribute the capital, but the shareholders are not there or will not be involved in the day-to-day running of the business. In other words, the shareholders will appoint what are referred to as the directors. So the day-to-day running of the business is vested in the hands of the directors. Then the directors appoint a chief executive officer or CEO or a managing director. The managing director will be the one who will be dealing with the day-to-day running of the business. All right. Now, do you notice that there's a difference here? If you look at the sole traders and partnerships, sole trader is the one who owns and is the one who manages and runs the business, makes all purchasing decisions, pricing decisions, recruitment decisions, or disposal of surplus assets or negotiating on behalf of the business. The same applies to partnerships. They own the business, they provide the capital, and they are the ones who will be managing the business. The distinction lies there, uh, which lies between the sole traders and the partnership, is that there is separation between ownership and control on companies. So someone owns the business and someone is involved in the control of the business. So the people who own the business are referred to as shareholders. So you can have thousands and thousands of shareholders. For some entities like Unilever, they have maybe 5,000 or 10,000 shareholders who are scattered around the globe. But then the day-to-day running is given to the body of directors of the company. Then, should the business fail to pay its debts, the shareholders will only lose those funds which they will have invested in the business. Why? Because the law is there to protect these individuals, these shareholders. Why? Because they only contributed capital, but were not there on the day-to-day running of the business. So they lose the funds which they've contributed in the business, their personal possessions like private house, cars, and other assets will not be affected. So that's the difference between companies and other unincorporated businesses. Okay, so I think you now know you now understand the concept of limited liability. All right, you now understand the concept of limited liability. So what then happens when we are running a company? You find that there is a perpetual existence or continuity. The death of one shareholder doesn't affect the running of the business. If a shareholder dies, then other shareholders can simply go on to make decisions at the AGM, what is normally referred to as annual general meeting of a company. So the death of one shareholder will not in any way affect the operations of the business. So the business will be able to continue to operate in that way or manner. So if you want to register your company, you can get in touch with the East Bay Business Consultants, which is located here in Harare, with the phone number is 263 776 751 735 +263 776 751 735. as its WhatsApp number or contact number here in Harare, Zimbabwe. All right. So East Bay assists individuals who want to register companies, and you can register your company and get free company registration advice during and after the registration process. East Bay also assists you on filing your tax returns, preparation of company accounts, and the day-to-day marketing process of the business. Now, let's go on to the part of the types of shareholders. We have the two main types of shareholders, like what we have indicated. We have ordinary shareholders and we have preference shareholders. What are ordinary shareholders? Ordinary shareholders are those shareholders who contribute capital, and the return on ordinary shareholders varies depending on the amount of profit made by the company. So ordinary shareholders are sometimes referred to as the real owners of a business. So they are sometimes referred as the real owners of a business. So they are sometimes referred to as real owners of a business. Why the term real owners of a business? Because they get their dividend after the preference shareholders have been paid. Dividends are payments which are made by the company as a token of appreciation by the company for the contribution of capital. So if you contribute capital to a company, the company will in return give you dividends. So it might be after every 6 months, it might be after every 12 months. It just depends with the profits which are available. If the profit doesn't make it, if the company doesn't make any profit, then there are no dividends which will be paid to the ordinary shareholders. But if the company makes more profits, the ordinary shareholders will get more profits, right? So that's the part of the ordinary shareholders. Then the preference shareholders, these get a fixed rate of dividend. These get a fixed rate of dividend, and they get their dividends before dividends are paid to the ordinary shareholders. So they get a fixed rate of dividend before dividends are paid to the ordinary shareholders. Why are they called preference? Because they have a first preference or priority over ordinary shareholders or over other shareholders within the business. But you find that there are also types of preference shares. So you have cumulative preference shares, non-cumulative preference shares, as well as participating preference shares. What are cumulative preference shares? Cumulative preference shares are those preference shareholders whose dividends, if they are not paid within a certain year, the dividend will be carried forward to the next accounting year or financial year. So in some of the circumstances, in reality, what happens, the company doesn't make profits. If the company doesn't make profits, then the dividends for preference shareholders will be paid until or in such a year when the company has enough cash, and the cumulative preference shareholders are then paid their dividends. So maybe year one there's no profits, then they're supposed to get $500. Then year two, there's no profits. They're supposed to get $500 as well. Then we are saying those dividends are carried forward to the next accounting year. All right. So those dividends are then carried forward to the next accounting year. And then when they are carried forward to the next accounting year, they are now paid at once or in full in that manner or way. Right, then non-cumulative preference shares. These are preference shares whose dividend will not be carried forward in the next accounting period should the company not have any profits. So if the company doesn't have the money, then the non-cumulative preference shares dividends cannot be carried forward to the next accounting year. All right. So if the company makes losses this year, then next year the company makes losses, then there's nothing which is paid to the non-cumulative preference shares. When the company now has profits or has made some profits, then that's when they get paid. Then participating preference shares, these ones, they have voting rights. They actually participated the AGM of the company. So most of the preference shares, like cumulative preference shares and non-cumulative preference shares, they do not have voting rights. The voting rights are rights which are given to the shareholders to participate on voting at the annual general meeting of a company. So at the annual general meeting of the company, the shareholders make decisions, say for instance, election of new directors, appointment of the auditors, right, the external auditors. They might also make decisions, major decisions, whether the company should have a merger or a demerger, or whether the company should seek to get additional share capital, which might sometimes refer to as a rights issue, or to buy back some of its shares. All right, or major decisions on the issuance of debentures, which is a loan stock. So those decisions are normally made at the AGM of the company. All right. Now we are saying participating preference shares, they get a fixed rate of dividend. Then after getting a fixed rate of dividend, they might also get another amount of a variable dividend. Normally, this is after the dividends have been paid, or just before or after dividends are paid to the ordinary shareholders. Remember, ordinary shareholders are the real owners of a company, and the ordinary shareholders have more voting rights or powers at the AGM of the company. Right, thank you guys. I hope you have mastered and enjoyed this part of companies, where we looked at the concept of limited liability and perpetual existence, as well as the various types of shares. So, as a recap, we have said limited liability occurs when a business debt, if a business fails to pay its debts, then the shareholders' personal possessions will not be affected. And the different types of shares which we have ordinary and preference shares. Ordinary shares having voting rights and participating at the AGM of the company, and they get their dividends after all creditors and other and preference shareholders have been paid. So ordinary shareholders are referred to as the real owners of a business. And we had a look at the part of the preference shares, where we looked at the non-cumulative, cumulative, and participating preference shares. In the next lesson, we'll then look at the part of prospectus and how each of shares will go through when we have an initial public offering. Thank you guys. We'll meet in the next video.